While the herd raised glasses to count down the year's final seconds, I was fixated on something far more telling than fireworks. On my rig at exactly 9:30 p.m. Eastern on December 31st, the silver spot price didn't just close the year, it was violently tamped down. In over a decade of watching the metals rig through crises rallies and thin holiday sessions, I have rarely seen a smash this sudden, this aggressive, and this perfectly timed. What went down in that final hour wasn't random, and it surely wasn't retail stackers taking profits before midnight. It was pure institutional force applied with absolute urgency. I'm a private commodities strategist. I've spent years trading the metals, tracking the vault flows, and stacking physical silver long before it was trendy to talk about it again. I launched this channel because I got sick of watching mainstream pundits arrive hours or days after the real move had already played out. And lately, with AI-generated hype tubers recycling the same tired, to-the-moon slogans, it's become harder than ever to separate the signal from the noise. So let me be clear from the start. This isn't about pump hype. It's about data timing and incentives. Silver ended at 71.39, bleeding over 5% in the final stretch of what was supposed to be a thin, low-volume holiday session. At that same time, almost to the minute, the Federal Reserve flooded $31 billion into the overnight repo market. That figure is key. It was the largest single injection since the meltdown of March 2020 when global markets were in freefall. Tomorrow's news will cheer silver's massive year-up triple digits, and technically they won't be wrong. But they won't mention the violence of that last hour or why silver was brutally rejected just below the highs. This chapter is about setting the frame. What you're seeing on the spot chart is not the whole market. It's a carefully managed illusion. Beneath it, something snapped, and the big boys needed time before regulators took their year-end snapshot. If that sounds conspiratorial good, it should. Because what happened last night wasn't the end of a story. It was the cover-up of one. If you want to grasp what really drives price liquidity and power in these rigged markets, make sure you're subscribed to the channel and drop a comment with the number 1 if you're tracking the manipulation, or 2 if this is your first red pill moment. Your engagement helps this analysis bypass the algos and reach people tired of recycled narratives. To understand why that final hour was so critical, you have to look past the headline prints and focus on behavior. The market speaks through flow, not excuses. And the action in silver that night was anything but organic. Before the smash, silver briefly tagged levels that hadn't been seen in decades. The rally was sharp, confident, and backed by momentum building for months. Then, without warning, it was hammered lower in a near-vertical drop. That is not how healthy markets correct. That is how positions are liquidated. When I analyze a candle like that, I'm not asking if silver was overbought or if traders wanted to bank some fiat gains. I'm asking who was forced to puke, and why the timing was so precise. The chart tells the tale, a small body with a long upper wick, what technicians call a shooting star. Price pushed up, hit a brick wall of suppression, and was driven back down with force. That kind of rejection doesn't come from thousands of small stackers clicking sell. It comes from massive size, from urgency, from a whale who cannot wait for a better price. At the same time silver was crashing, gold stood still. That divergence is the smoking gun. In periods abroad, risk-off selling precious metals usually tank together. But here gold was calm, while silver was murdered. That tells me this wasn't a macro decision about the metals sector. It was a hit job. Something specific to silver broke, and it broke fast. Now add what was happening offline. I was getting texts from bullion dealers and contacts across multiple regions saying the same thing in different words. Physical silver was not moving anywhere near the spot price. Premiums were exploding. Supply was non-existent. Deals were striking at levels that made the paper price look almost fictional. When you hear that story, once you stay skeptical. When you hear it from different continents within hours, you pay attention. So ask yourself a simple question. If you cannot actually secure the metal at the screen price, what does that price represent? Is it a market or is it a reference number rigged for convenience and control? That question sits at the core of everything that follows, because once spot price divorces from reality, the system becomes fragile. And fragile systems don't break slowly. They break all at once, usually at the worst possible moment. The velocity of the drop is what removes any remaining doubt. Genuine profit-taking has structure. Smart money unwinds positions gradually to minimize slippage and avoid signaling stress. What happened in silver had none of those traits. It was sudden, concentrated, and indifferent to price levels. That behavior only appears when selling is not optional. This was forced liquidation. The timing confirms it. This did not occur on a random trading Tuesday. It happened in the final hour of the final day of the fiscal year. At midnight, banks face a regulatory snapshot of their balance sheets. Capital ratios, leverage, and risk exposure are frozen and filed. If a position looks toxic at that exact moment, waiting is not an option. You either neutralize the exposure or fail the audit. This is where year-end window dressing becomes critical. Every large bullion bank understands this process. It's not about fixing the insolvency. It's about hiding it. Positions that look dangerous are temporarily flattened, losses are compressed, and liquidity is sourced to make the books passable for one specific moment in time. Once the clock rolls over, the real damage can be dealt with later. Think of it as controlled concealment. When there isn't enough time to clean the mess, it gets buried. Silver became that mess. The market ate the shock, and something massive disappeared from view just long enough to make the books look stable. But liquidation alone doesn't close the loop. Selling creates settlement obligations. Cash must be delivered. Margins must be posted, and that's where the second half of this event matters. While silver was being driven lower, liquidity was injected elsewhere in the system rapidly and at scale. When price action and emergency repo liquidity appear together, they stop being coincidences. They become evidence of necessity. The liquidity injection is the detail most stackers overlook, but it's the one that changes the entire interpretation. Labels don't matter here. Size and timing do. $31 billion does not move through overnight funding markets without pressure behind it, especially not in the final hours of the year. Look at when interventions of this scale usually drop. They show up during moments when financial plumbing stops functioning smoothly, not during calm seas. The purpose isn't to prop up prices or send signals. It's to prevent a breakdown from spreading. One counterparty under stress can quickly become a systemic contagion if it cannot meet short-term obligations. Now line up the sequence. Silver rips, then collapses violently. A large position is forced out. Immediately after massive liquidity appears through the repo facility. Repos exist for one reason: to provide immediate cash to banks that need it now. When they are used at this magnitude, someone is facing a funding shortfall that cannot wait. Large silver shorts are not trivial exposures. They involve enormous leverage and tight margin requirements. A sharp adverse move doesn't create discomfort, it creates insolvency risk. When that happens, at year-end survival becomes the only objective. Calling this routine misses the point. Routine ops don't coincide with emergency price action. When both appear together, the simplest explanation is damage control. Something had to be stabilized before the books were frozen. And when markets are forced to serve that purpose, natural price discovery is the first casualty. Once you accept that this was a survival maneuver, the rest of the puzzle starts to fit. The market behavior that followed wasn't about confidence returning or traders reassessing value. It was about control. After the liquidation, volume dried up instantly. That kind of silence doesn't happen in a healthy correction. It happens when participants step back, unsure whether the price they're seeing is real or simply being painted. This is where the gap between paper and physical becomes impossible to ignore. On the COMEX, silver printed prices in the low 70s. In the real world, where metal actually changes hands, availability tightened and premiums expanded. When two markets for the same asset send opposite signals, one of them is lying. And it's never the market that requires delivery. Paper markets are flexible by design. Contracts can be rolled, settled in cash, or extinguished with accounting entries. Physical markets are not. Bars cannot be printed to meet demand. When inventory's thin and buyers compete, price is supposed to rise. If it doesn't, something else is absorbing the pressure. They shifted that squeeze into pure regulatory theatrics. They jacked up margin requirements aggressively to flush out the little guys and slash open interest. This isn't about protecting traders, it's about shielding a rigged system when it's brittle. Fewer players means fewer blowups. and fewer blowups means preventing a total systemic meltdown happening. You weren't watching a free market reset, you saw a corrupt system defending itself. They slammed the paper price not because stacking demand vanished, but because stability required it. And stability in this rigged casino meant ensuring a specific problem didn't spread way beyond its point of origin. But here is the fatal flaw. Tamping down the spot price doesn't fix the shortage, it just kicks the can. The hunger for physical doesn't vanish because a chart dumps red. It waits, and when it returns, it grabs metal with way more urgency. That is the danger embedded in this tamp. The real problem wasn't solved, it was merely postponed. Kicking the can down the road in these markets doesn't cut risk, it concentrates it. Once the year-end books were cooked, the immediate threat faded, but the physical deficit remained. The question shifted from if the system could survive the night to whether it could ever function without constant artificial life support. This is why the days after the tamp are more critical than the crash itself. One bailout is a fluke. Repeated rigging is a pattern. If liquidity exits and the price holds the line, naturally stress was contained. If not, the structural break was never actually fixed, it was only deferred. That's why I track the plumbing, not the news. Open interest swap rates and delivery demands tell the real story. If open interest stays high after a smash, the shorts are still there. They've been masked, not covered, and hidden risk like that tends to blow up again very suddenly. Mainstream narratives spin up fast to normalize the rig. Charts get blamed after the fact. That isn't analysis. It is pure damage control. Paper price stories don't change the physical reality. Real availability and vault delivery do. From my view, the physical market hasn't cooled off. Bullion dealers stay wary. Premiums stay fat. That implies the squeeze is still alive under the hood. The washout fixed a paper ledger, not the metal deficit. And supply deficits resolve through much higher prices eventually and very forcefully. This grind rewards patience. When markets rely on intervention to open, they aren't stable. They are conditional. And conditional systems always face a moment when the conditions can no longer be met or sustained. This is where positioning becomes more important than prediction. I'm not interested in guessing tomorrow's price or chasing intraday volatility. I'm interested in identifying whether the system is regaining balance or sliding deeper into dependence. For me, one level matters more than any other right now. 71. That price is no longer just a number. It's a line of full credibility. If silver can hold above that level through the first real trading days of the year, it tells me the selling pressure was tactical, not structural. It suggests the forced liquidation accomplished its regulatory purpose and nothing more. In that scenario, stacking demand hasn't weakened. It's simply been temporarily restrained. And restrained demand tends to reassert itself quickly once the pressure is finally lifted. But if that level fails decisively, especially on expanding volume, the interpretation changes. A deeper move lower would imply that the liquidation was not just cosmetic. It would suggest a broader unwind, possibly involving multiple players reducing exposure simultaneously. That's not a market I want to engage with aggressively. That's a market that is still in triage. I'm also watching behavior, not just price. Does volume return after the drop, or does participation remain thin? Do bids step in confidently, or does every rally meet immediate resistance? Healthy markets invite engagement. Fragile ones repel it. Right now, hesitation is the dominant emotion, and hesitation is clearly never neutral. This is why I'm comfortable doing less, not more. Capital preservation matters more than activity during periods like this. If the system is still leaning on support, direction becomes less important than risk management, and there will be opportunities later when price reflects reality instead of naked necessity. For now, I'm letting the market show its hand. Stability will reveal itself through consistency, not commentary, and inconsistency, especially when paired with continued intervention, is the clearest signal that the story isn't finished just yet. Beyond price levels and volume, there is one mechanism that quietly confirms whether stress has truly passed or is still being concealed. Liquidity facilities. Emergency funding is never meant to become routine, even though it is often described that way after the fact. The real signal isn't the announcement. It is truly what happens next. If the repo balances shrink quickly and disappear from the conversation, it means the system absorbed the shock and moved on. That's what resolution looks like. But if large sums continue to roll forward week after week, it tells you the problem wasn't solved. It was stabilized. And stabilization is not recovery. It's just maintenance. This is why I pay close attention to repetition. A single intervention can be dismissed as coincidence. Multiple interventions form a pattern, and patterns reveal dependency. When institutions rely on continuous liquidity to function, markets stop reflecting supply and demand. They reflect survival priorities completely. There's also a psychological element here that's easy to underestimate. Traders sense when a market is being managed. Participation drops. Risk appetite shrinks. Everyone waits for confirmation that it's safe to engage again. That waiting creates artificial calm, but calm, driven by caution, is fragile. It breaks quickly when it is tested. What makes silver especially dangerous in this context is its dual nature. It's both a monetary metal and an industrial input. When price signals are distorted, neither side can plan properly. Producers hesitate. Buyers stockpile. That tension builds quietly until it releases through repricing forcefully. This is why I don't expect resolution through commentary or reassurance. I expect it through action. Either the system proves it can stand on its own or it reveals continued dependence. And continued dependence always comes with a cost, usually paid later and usually paid all at once, effectively. When markets reach this stage, clarity comes from watching what fails to happen as much as what does. If price remains suppressed, while physical demand stays firm, the gap widens. And widening gaps create pressure that no narrative can relieve. That pressure builds silently until it reaches a point where maintaining the illusion costs more than abandoning it completely. This is where history becomes useful. Similar patterns have appeared before, not just in metals, but across asset classes. Temporary suppression, emergency liquidity, and confident explanations often precede a repricing event rather than prevent it. The longer control is maintained, the more abrupt the adjustment tends to be. Stability bought with intervention is only borrowed time. Another signal I'm watching closely is participation. If fewer players are willing to provide liquidity, spreads widen and depth thins. That makes the market more sensitive, not less. Small orders move price more than they should. Volatility hides, then returns suddenly. This is how controlled environments break. Not through gradual change, but through abrupt failure happening. What matters most is trust. Markets function because participants believe prices are fair reflections of reality. When that belief erodes, behavior changes. Hoarding replaces trading. Waiting replaces risk-taking. And once trust is gone, it doesn't return easily. It has to be rebuilt through transparency, not force alone. I don't need to know the exact moment repricing occurs. I only need to recognize when conditions make it inevitable. Persistent premiums, repeated intervention, and declining participation are not signs of health. They are warnings. And markets are generous with warnings before they become unforgiving to all. At this stage, patience is not passive. It's strategic. Letting the system reveal whether it can function without assistance is the most valuable information available. Everything else is just noise. What this ultimately comes down to is not a short-term price call, but a structural lesson about how modern markets really function. Screens can display any number they're told to display. Liquidity can be routed, delayed, or injected to meet regulatory needs. Balance sheets can be made to look clean for a moment in time. But none of that creates metal. None of it fixes shortages, and none of it changes the physical reality. Institutions have proven they can manage paper prices when survival demands it. They can compress volatility, force liquidations, and control narratives long enough to pass inspections, but they cannot manufacture supply. When physical demand persists and availability tightens, price discovery doesn't disappear. It just waits. The key lesson here is patience paired with awareness. Don't confuse intervention with resolution. Don't mistake silence for stability. Watch the infrastructure, watch behavior, watch what requires support to keep functioning. Those signals tell you far more than any headline ever will, really. Strategically, this environment rewards discipline. Protect capital when systems are conditional. Add exposure only when price behavior confirms stability rather than necessity. Structural mispricings are opportunities, but only when risk is understood and timing is truly respected. Crucially, keep in mind that spot markets must eventually reconcile paper promises with physical reality. The only variable is the timing of the squeeze and who holds the ounces when it snaps back. Physical shortages always reveal the truth, despite the sophisticated naked shorting schemes used by the banks. If this report helped you look past the spot price manipulation, support our stacker community by liking, subscribing, and sharing with a fellow ape who craves real data over mainstream propaganda. Drop a comment with your stacking goals or what you are buying. That interaction is what keeps this independent sound money content alive. The new year is here, and the true test for the fiat Ponzi scheme has just begun.